Sustainable investing is really about acknowledging how interconnected our systems are. And that's really across environmental health, social equity, and long-term economic performance. And we use sustainable investing as an umbrella term to really define 3 different investor approaches. The first is ESG integration, and that's really investing in a changing world. So that's really helping us better understand how ESG risks and opportunities manifest in our portfolios. It's about better pricing and externalities. It's about better evaluating companies, just using additional information in the investment process. And an example of that is if a company in your portfolio were building a mega factory or a plant on a coast, wouldn't you want that asset manager to be looking at flood risk data and information when they're evaluating that company? Similar to how a person would look at flood risk data if they were buying a home. The second is values alignment, and that really is aligning your portfolio with your values, whatever those values might be, across environmental issues, social issues, or even religious issues. And that's usually implemented through screening, negative screening. And the third area is thematic impact, and that's really investing to change the world. So investing in specific targeted impact outcomes across areas like affordable housing, for example, or climate, or social inequity, or water scarcity, for example. So those approaches are really fueled by investor motivations, and they can overlap, which can be very confusing to an advisor, but it's important to, again, focus on those investor motivations and marrying and matching those to the investment approach and strategy that will ultimately result in better client outcomes. Investors now are starting to see that they can potentially talk to their financial advisors about how to really invest to reflect those same concerns they might have in other aspects and areas of their lives, across areas like diversity and equity and climate. And there's also just a lot more access to information and a demand for real transparency. I think people are more awake and alive, and they are holding companies accountable. The access to information and the dissemination of information has been so rapid and is so rapid, and people are realizing through that they can really, again, allocate their capital, their investment portfolio can be more aligned with the things that they care about, value. As you're sitting down and having these regular check-ins with clients around performance, around retirement, around their various goals, saving for their kids' college, there's another element here around sustainable investing and what are your sustainability goals and how can we start tracking those over time. I think too, when you think about generational wealth and the legacy that you want to leave behind, as investors get older, they start to really realize that that's part of the conversation. Sustainable investing can be such an important piece of that legacy and what is your mission and what you really want to leave behind, because your investments ultimately are a big way that you can make a difference in the world, your capital and how you allocate it.